Our guest today is Devina Mehra, founder and CMD at First Global. Devina, so good having you. Thanks as always for taking the time out.
Good morning, Neeraj, and to your viewers, and thanks for having me.
Yeah, no, the pleasure is and will be entirely ours. So, Devina, it's been a landmark year of sorts, mired no doubt by a number of events, both local and global, but you would have to admit that at the end of it, if you look back, uh, I mean, I wouldn't be too wrong if I say that we've come out smelling like roses.
You're talking the Indian markets, yes,
Yes.
certainly.
Indian markets, yes.
And as we've spoken in the past, a lot of it came out of underperformance in the prior period. So, we all have this nice little figure of 15-16% equity compounding in Indian markets, but there was a whole decade of that 2010 to 20 where we compounded only just over 8.5%. So 100 rupees became only 230 rupees at the end of those 10 years. And contrast it with 1980, if you had invested 100 rupees, that would have become 710 years. So that was the kind of gap that was created. So you were far below the trend line. So as I've been saying for a couple of years, I have been expecting the Indian markets to do well. And even after that whole move we've had post-COVID, even in this period, we have not been at that 15-16% mark. So we're not above the trend line if you look at that entire 13-14-year period. So there's still room, which means that risk of a crash is reasonably low. And that's what you've been seeing playing out in the market. Of course, this year has been very good for the small cap, mid cap, even micro caps. But that's the place where I would advise caution.
Okay. Now, viewers, the case for a chat today, of course, amongst all the other things that we'll talk with Devina Mehra, the case for a chat, how much steam do the Indian markets have? That's just the obvious question that comes out every single time. Even if guests say that, the one question that you don't ask me, कि market क्या लगता है? Assessing markets from a top-down perspective, and our valuations in large caps comfortable. Now, the reason why I've put in the large cap question is because most people are currently comfortable on large caps and not comfortable on mid caps and small caps. Now, the beauty about a conversation with Devina Mehra, so I'll just take 30 seconds more, is that she views global markets, she views global asset classes and is nimble enough to move and juggle between all of these to be in the right quadrant at the right time. So, Devina, my starting question to you is, if you are thinking of being in the Indian markets, if an investor is the investor therefore being in the right quadrant at the start of 2024?
Okay, if you look at where you should be, as I said, the place to be in general, be cautionary is small, mid cap, etc. Which is not to say that you will not find anything there. It's not like that because not everything is a category or a sector call. For example, if you look at last year, IT has as a sector has not been a great performer, but our number one performer in our PMS is a mid cap IT company. So also in previous years we've had ITC and Raymond in top 5, whereas those were not sector calls. So, with that cautionary thing, in large caps, I would say the part to be cautious about is actually the largest weight in the index, which is the banks. So, that's the part where we would be quite underweight. And that was a conscious decision. And as people tell me that you keep repeating this line, but that is true that I'm a nervous investor in banks and lenders. So unless there's a compelling case made, I would avoid being overweight there. And the only time we went even market weight was in 2022. And if you look at the last 4 years, 2022 was the only year where the bank Nifty outperformed the Nifty or an S&P 500. This year, last when I looked few days ago, the bank Nifty was up 9-10%, whereas Nifty, because of the drag of the banks, was up 15, and S&P 500 was up 20. So that's the kind of scale you're talking about. And 2022, of course, the banking cycle was turning benign with NPAs going down and credit growth improving, and the beginning of a rate hike cycle, which helps expand margins for banks. But that story is over now. There are more cautionary signs. So this year we've been cutting back on banks. the space which we have liked, not recently, I mean, most people discovered it in 2023, but we've been overweight industrials and capital goods for over 2 years, since October 21 to be exact. And we, of course, we still evaluate every quarter. Is the story over? Till now, our systems have not signaled that that story is over. Of course, we've cut back from where we were and we booked profits and all of that, but we remain overweight. In 2023, where we have added has been auto components, again, as a sector that's done well this year. Pharma is another space. We added a few construction names also. So broadly, that would be the landscape of how we are positioned in the Indian markets.
Okay, so negative on banks, added in 2023, auto components, pharma and construction. And sorry, I missed out, Devina, you're positive, you continue to remain positive on which sector you mentioned?
I said capital goods and
Capital goods and
industrials.
industrials.
So, I mean, we evaluate every quarter. So, I mean, every quarter we look at things as that if we had cash today, where would we invest? That's the question we ask to, avoid some of the biases which are so hardwired into us, including endowment bias, that you always think that what you hold is more valuable than something you don't hold. So, to get rid of that, we really do zero-based kind of rebalancing every quarter. But as of now, we still remain overweight capital goods and industrials.
Got it. Now, Devina, interesting view on banks. I think the macro argument that you present, I mean, I can't even question you because you are a better expert there. But the larger point is, almost everybody is of the opinion that if the private capex cycle is due to happen, then, and if the Indian economy is to grow, then BFSI and lenders will certainly grow. Now, are you getting out of banks because you're getting better growth opportunities elsewhere, or do you think banks as a pocket will underperform the benchmarks, if you will?
Well, I mean, banks, if you want to look at data, how they have done, see, because this data that if India has to grow, lenders have to grow, has been, I have heard this all my life, all my working life at least, because, this can be made at any point in time. But let's look at the data. 2020, Bank Nifty was the only sector index in the negative. In 2021, it went up only half as much as the market. I think market went up 22, this went up 11. Only in 2022, it was a substantial outperformer. I think the market was up 4.5% and Bank Nifty was up 20% plus. A lot of it, of course, was PSU. And even now, what we hold in banks is a little skewed towards PSU. But in the last 4 years, there's been only 1 year when it has outperformed the market. And as I said, that was the only year where we were market weight, let alone, and because of price movement, it became overweight. But the issue with banks, which I have fundamentally, is that it is a leveraged sector with a high propensity to give negative surprises. And sitting outside, you don't know where the negative surprises are hiding, where the NPAs are going to come from, where which credit is going to go bad. And now you will have it not just at the corporate level. I mean, I see it happening even with the smaller retail loans, because one can anecdotally see that borrowers are borrowing from multiple sources. Maybe they're using it for consumption as their income is not keeping up. So those are all warning signs. And as I said, unless there's a compelling argument to be in banks, I'd rather not be in banks. If it was not such a high weightage in the index, I would have been happy not even to look at it. But as I said, the data is what it is, that in 4 years, there's been only 1 year when banks have outperformed. I mean, people tell stories, but this is the data. So it's anyway a sector, even if you are chasing performance, you have to be cautious about.
Okay. Okay, fair call. Devina, and I'll come to the micros and talk about some of the stuff that you positive, negative, etc. on. But just the larger picture, if I'm asking you whether, because there are so many global voices who are talking about how India is looking like one of the most promising large economies to invest in, and large global money managers talking about the same as well, who have a maybe 5-year view or happy with 15%, 12% returns, who knows. But everybody's talking about that. My question to you is, can flows at large into India remain constructive for the next 2, 3, 4 years? I know you moved on from the sell side to the buy side, but I'm asking you to maybe don a small sell side hat for a brief 1-2 minutes and think about this thing and tell me what you think.
Okay, first of all, when I was on the sell side and I entered, I quit Citibank and I started this business 30 years ago because the trigger, one of the major triggers was that the market opened to FIIs. It was Dr. Manmohan Singh's 93 budget, where he 92, 93 budget, where he opened the market to FIIs, and I said, now the market will professionalize. So it was the entry of FIIs in India was coincident with the start of First Global. But having said that, in the beginning, one used to track the FII flows very closely. And because you tracked it, you realized that there was no correlation between the FII flows and the market moves. Not just on a 1-year basis, but even on a 1-month basis, or if you look at a longer time. 94 is when the FII money started coming into India in all seriousness. And this was a new source of money. So you did, and you remember, you did not have a domestic mutual fund business. I mean, only large institutional investors in India were UTI, LIC, etc. You did not have anywhere close to this level of retail participation. So this was a new source, and it was a disproportionately large source where billions of dollars were coming in. But markets went up and down. But from 94 to 2003 is the only 9-year period in Sensex history where the returns were zero. So that's the context. So just because some money comes in, we make a leap without even realizing that it is a leap in the logic, saying that obviously if FII money comes in, the market will go up. But is that the case? In fact, when I started tracking this, I think, obviously in the beginning, every month the FII flows would be positive because they were new buyers, so they were obviously net buyers. But the first month when that flow became negative, meaning FIIs became net sellers, I think it was November 96. I may be wrong, but but on the month, but that month the market went up. So I realized there was no correlation. So now I don't even track FII flows except from the balance of payments side. I do not. I mean, it is nice to talk about it. It fills up. I think
Okay.
some time, but it is not something that is relevant for the market move.
Okay, no, but just maybe not an immediate correlation to the market, but at large, if global flows are constructive, that is an added benefit or a cushion, right? Because domestic flows we know are very strong. Fund managers like you, some of the other domestic guys have now been the, what do you call it, the linchpin on which this market is moved. But it's great to have flows, right? Global flows.
That's great to have flows, but you can always say that FPI is more volatile than FDI. Again, if you're looking at the economy as a whole, so so there are when the outflows happen, then there is a lot of heartburn. So as I said, from the market move, it is not very relevant, and a lot of the global flows also are. The decisions are more as emerging market as a basket. And if you look at even past bull markets, oftentimes, that everything moves as a basket more than only one economy.
Got it.
Yes, I mean, you are becoming a somewhat bigger player than they used to be. If you look at the market cap rankings, India obviously has moved up. And so that itself would bring it on the radar of more fund managers or little more attention than it used to be.
I heard you say that being in Indian markets from a quadrant perspective might actually not be a bad idea. In fact, it might be a good idea, and correct me if I'm wrong here. Almost the most common word or thoughts that I've heard though recently is that just be very careful of mid caps and small caps and stay in large caps. Now, I heard you say that it doesn't mean that there won't be opportunities there. So I would love to understand, in a pocket which is likely to, in the minds of a lot of investors, underperform, where is it that you find the highest opportunities? What themes? Because there are a clutch of sectors out there which don't have a large cap presence. So you have to be in the mid caps and the small caps if you want presence there.
Okay, Nilesh, first of all, let me just finish with that global thing. The one point
Sure.
which I did not mention was that, on a relative basis, we think, besides relative to its own history, but relative to the globe also, we expect India to outperform. And in our global funds also, we are overweight India. So, that is, so I was only talking of whether the FII flows have a correlation, and
Yeah,
maybe
yeah,
the
yeah.
causation works the other way, that because India will do well, you might get flows rather than the doing well coming out of the flows. In terms of mid caps, of course, you will find opportunities. Small caps, especially when I'm talking small caps, as in uh, between 1,000 and 5,000 crore market cap. We don't even look at things below 1,000 crore, but even in the 1 to 5,000, even when things look very good, we rarely go above 20% weightage. So that is what I would like to tell even retail investors, that limit your exposure. We're not saying that it should be zero. Limit your exposure, and be also cognizant that in small caps, the falls can be very dramatic. And I'm saying this especially because a lot of investors are in the market are very new. You know how the number of investors has grown in the last 2 3 years, and they do not have a sense of history. So the small cap index in 2008-9 fell nearly 80%. Nearly, it was 78% to be exact. And if you think you can choose carefully, only 1% of the stocks did not fall. And the index reached its old level only in 2016, again, after 7 8 years. And actually speaking, it was a whole different index, because the small cap index itself changes 18 20% a year. So many of the stocks that fell just disappeared. And that is the risk really in small caps, that a lot of the stocks disappear. If you look at the number of stocks that have listed over the years, and you look at how many stocks are trading today, which is just over 4,000, you will realize how many companies have just vanished into the blue yonder. So that's the risk that the investors must understand, that in large caps you can have a small stop loss, but in small caps, when the stock starts to fall, there might be no exits left. So you have to be very careful, and you have to limit your exposure. It need not be zero, but you have to limit your exposure. And for us, I've already spoken of the sectors we like, and that really comes out of, we follow a very systematic approach, because human beings are prone to bias, they're prone to random noise in their decision making, and the only way really to sidestep that is to have a system. So we have a fairly elaborate artificial intelligence and machine learning driven system, which actually ranks all stocks over 1,000 crore market cap and meeting certain liquidity criteria, which is about 700 odd, from like 1 to 750. And then we might choose 50 or 55 out of the top 70 75. So that's the way we do it, because that looks at a very wide variety of factors and then ranks them. So that imposes discipline on us. And normally we will not make that many top-down calls. So our uh, portfolio is a resultant of this is one system. We have other systems also. And mostly it is not as if that we will decide that we want to be in this sector and go all out. Only thing, which we do top down, is that if one sector is becoming too big a portion of the pie, then we will limit it. So our whole system is oriented towards risk management, and that's what. So limit exposure to a single sector, limit exposure to small caps, have stop losses. So those are the kind of disciplines that investors should follow, even if they're doing it themselves. So be very rigid on the discipline, because otherwise your mind will always tell you, give a stock, but it will go up again. This time it is different. And so basically humans do not want to book losses. They do not want to admit mistakes. So those are the things which you have to guard against.
Behavioral biases as well. Well, trust Devina Mehra to give us those in some conversations like these as well. But while we are out of time completely on this, I just want to wrap up with something that Devina said, which was the best thing that I think I've heard in a long while, wherein I told Devina Mehra that, Devina, in God we trust, everybody else must bring data. And Devina Mehra said that, Neeraj, we say that even God must bring data. Devina, thanks so much, and wishing you and Team First Global and everybody in the family a very happy 2024.